Hey everyone, welcome back. Over the past few weeks, there have been two major events in the stock market which have shaken up the investing world and made news headlines around the world. Tesla and Apple announced stock splits. This earth-shattering news, which changes the face of investing forever, has made the front page of seemingly every publication in the world, and in turn boosted the stock of each company at least temporarily higher. Now, if you can't tell, I'm being sarcastic. To be honest, if I could pick one of the least interesting things a company could do, it would be to split its stock. But before I get too far into it, let me break down what exactly a stock split is and what it isn't. To give you some background on what I'm talking about, Apple recently announced a 4-to-1 stock split, meaning that for every share of Apple stock you own at the time of the split, which is August 31st, you will receive 4 shares of Apple stock back at a quarter the value that they were before the split. Following this news, Apple's share price was up almost 19%. A few days later, Tesla also announced a stock split, in their case 5-to-1. And immediately following that news, Tesla was up 12.5%. What a stock split is when a company with an expensive stock, let's say $1,000 a share, decides to split that stock into a bunch of smaller pieces that are each cheaper, let's say $100 a share. Now everybody who had one $1,000 share instead has 10 $100 shares for a total value of still $1,000. This means that a stock split has absolutely no effect on the actual value of a company, or at least it shouldn't. So why then would the price of a stock rise after a stock split? Well, there's a couple possible explanations, one of which is once you split an expensive stock into a bunch of cheaper stocks, it becomes easier for a wider range of people to buy. This greater pool of people then drives the price of the stock higher. Well, is this really reasonable? In order to move the price of a stock dramatically, you need to have a lot of money rushing in to buy more of the stock. So how big is this pool of people who would buy the stock after the stock split but not before? Well, let's think it through. First off, we are looking at people who are interested in buying the stock but don't have enough money to buy it at its current share price, meaning they probably don't have enough to buy very many of the shares after the stock split either. Second off, we're looking for people who don't have the ability to already buy fractional shares, which is offered by most mainstream trading platforms including Robinhood and Charles Schwab. So at this point, we're looking at people who are interested in buying the stock, who don't have enough money to buy the stock at its current price, and yet are on some kind of niche trading platform that doesn't offer fractional shares. And we're expecting this group to have enough market power to actually move the price of the stock higher. That doesn't seem very likely to me. So what is it then? If it's not increased liquidity causing the share price to rise, what could be boosting the price higher? Well, I think the simple answer is hype. The price of the stocks went up for both Apple and Tesla because people thought the price should go up. They saw a few news stories about the stock split and got really excited about it and started looking for all the other news stories about the stock split. The news organizations saw this, so they started writing more and more stories about it, which then led to other people getting interested in the topic, thinking, if everybody else is covering this, this must be an important topic. And then all of a sudden you have all this hype built around something as simple as a stock split. But who are these individuals who are looking at buying a stock not based on the underlying value of the asset, but instead just expecting the price to go higher and then they can dump that onto somebody else? Well, I think this is a group that traditionally hasn't had all that much market power, but in recent times is starting to gain a lot more power over the market. Novice investors. When I say novice investors, I mean people who have been investing for all of 10 minutes. They saw a news story about an Apple stock split, they went and they signed up on Robinhood, they got their free stock, and then they just decided to throw a little bit of money into the market and see where it goes. This type of investor doesn't care about things like research, due diligence, or even rationality, to be honest. All they care about is that they can buy a stock and then sell it for a higher price later. It's really just a fun pastime for them. They're not super concerned about making a lot of money, so they don't bother in putting in a ton of effort, so instead they just do what's fun and what feels good in the moment. Now, if you don't know anything about stock investing, you haven't watched my 5 do's and don'ts of the stock market, you might think that once a stock is split, that means that eventually its price is going to have to go back up to where it was before. This is the psychological phenomenon known as price anchoring, where people feel like just because a stock was at a certain price before, it has to go back to that number later. Now, this is actually a fallacy which does not hold true in the actual market, But if you weren't aware of that, it's easy to fall into that trap. In reality, the price of a stock has absolutely zero correlation with where it was before. Just because a stock is at $99 doesn't make it any more or less likely to go to $100 than it is to $98. I think, quite simply, there's been a surge in investors who either don't know what a stock split is, or who don't realize that price anchoring is not an actual method of investing effectively. I think that this has been led by the advent of really easy-to-use apps like Robinhood and Webull, which make it easy to sign up without any money down and just get into the market and start playing around. I think this has also been bolstered by the fact that a lot of people are stuck at home and don't really have anything else to do, so they decide to try their hand at the market. This set of circumstances has basically injected a dose of irrationality into the market. Now, don't get me wrong. I love the fact that people are getting interested in investing. It's so important that you understand how compound interest can grow your net worth, and it's why I make videos like this in the first place. But at the same time, I think it's important to be an informed investor and to make investments and not gambles, which is also why I make videos like this. I've noticed that my stock investing videos have been getting way more views than the other type of content I've been producing. I think a big part of this is inexperienced investors stumbling across my videos while trying to actually inform themselves on the market. If that sounds like you, hey, thanks for stopping by. It's really good that you're trying to get yourself more informed about the market. It's extremely important to educate yourself before throwing yourself into the market. Investing can and will make you rich if you put in the effort. But if you don't, it's just gambling. And chances are you'll end up disillusioned and a little bit poorer when it's all said and done. If you want to get started with investing, I recommend you watch my earlier video when I talk about how to get started in stock investing. And if you don't already have a trading platform, there are a couple that I've used that are really easy to use and get into. One is Robinhood, where when you sign up, you get a free stock. I'll include a link to that in the description. Another one is Webull, where again, if you sign up, you get a free stock. And then if you deposit $100 or more, you'll get a second stock valued up to $1,400. The third good option is Acorns, which is designed to basically invest your spare change for you. On that one, if you put $5 into the app, you'll get a $5 bonus. These trading platforms are designed to make it easy to get started with investing, and I think that's a good thing. Just make sure you do a little bit of research first. And if watching videos is your way to do it, more power to you. With that said, I hope you enjoyed this video. If you did, make sure to leave a like, and if you want to watch more videos like this in the future, make sure to subscribe. I'll see you next time.